Stanley Black Decker, stock ticker symbol SWK, has taken quite a beating ever since they released their earnings this week. Just looking at the 5-day chart, we can see they dropped around 20% after they released their earnings. And if we look at a longer chart, 5 years, we can see they're actually trading dangerously close to the same level as they were after COVID hit. Stanley Black Decker, they missed both on the top and the bottom line. And in addition, they also cut guidance around 50%, where they are now anticipating between $5 to $6 a share. And the previously anticipated was $9.5 to $10.5 a share. And they cite that the macroeconomic environment, including inflation, rising interest rates, and significant slow demand in late May and June, drove the majority of the challenges we faced in this quarter. And they are needing to accelerate a strategic transformation to combat this. And they also said that we began taking immediate corrective cost actions, which we continue to implement. So that is a cost savings plan in worth of $1 billion they are trying to implement. And as a note from the earnings call as well, their priority is to generate a lot of cash forward. And that is something that we will take a look in the financials. That is actually something they really need to do. But I have no doubt in my mind that Stanley Black Decker is capable of doing it, because Stanley Black Decker is a member of a very, very elite group of companies that is considered a dividend aristocrat. And you can see here that they are on the list here from the US News. And a dividend aristocrat is somebody that has raised their dividend payout for 25 consecutive years. And in addition, they need to be a member of the S&P 500. They need to have a market cap of at least $3 billion. And they need to have at least a trading volume in average of around the 5 million mark. In addition to being a dividend aristocrat, they are also a dividend king, as you can see here. And that means that they have raised their dividend payout for 50 consecutive years at least. And in Stanley Black Decker's case, it's actually 54. So I have no doubt in my mind that the board is very much focused on producing cash and keeping that dividend going. If we take a look at the fundamentals, you can see that it's trading at a forward PE non-GAAP ratio of 11.16, and that's actually around 36% lower than the 5-year average. And if we go down here to the price to book, we are getting a very, very juicy 1.45 compared to the 5-year average of 2.48. So it could indicate that right now Stanley Black Decker is at a very, very fair valuation. For the dividend, right now Stanley Black Decker is offering 3.21 in dividend yield, and they have a payout ratio of just shy of 36 and a 5-year growth rate of 6.38. And as mentioned before, it is a dividend king, so they do have the dividend growth for 54 consecutive years. For the dividend, I think it's very safe going forward still. I don't think they will jeopardize this payout in any way, so they will take whatever means necessary. They have to keep it up. If we take a look at the financials, we are looking at the annualized statements, and you can see here the last income number is from January 2022. So this is before everything happened right now, but you can see that the revenue is growing. And if we scroll down to net income, you can see that it's also chugging along quite nicely. You can see here from the trailing 12 months, it's taking a bit of a hit. And that is what we just talked about with the inflationary cost and a large inventory due to the softer demand. If we take a look at the cash from operations to see our free cash flow, you can see here that usually they had more cash from operations than they had capital expenditures, and it was actually growing year over year until we started to hit here with the supply issues. And now you can see here that for the trailing 12 months, they are actually negative on cash from operations, and they still have their capital expenditures. So that means that it's actually a cash flow negative company right now, meaning they don't have free cash flow to cover the dividend. So they would be needing to take out debt or sell stuff cheaper to generate some cash to pay out the dividend. If we take a look at the balance sheet, we can see that the cash and equivalents are quite low right now, but you can see down here that the inventory is quite high. So they do have a lot of stock they haven't been able to sell due to the softer demand. And if we go down a bit here to see the long-term debt, we can see that it's pretty okay. It's manageable. It's not huge. They can probably take on a bit more to keep the dividend going if that is what they would prefer to do. Of course, it's better to have it covered by free cash flow, but they aren't able to do that right now. And if we look down here, it seems like they had been issuing more shares year over year, but in the last report, it looks like they have actually aggressively bought back a lot of shares. And I haven't looked closer into that, but that seems very nice if that is the case. And again, down here, the total debt versus net debt, they are almost out of cash on hand right now. So they would need to take on additional debt to keep the dividend going, I believe, unless they find some way of magically conjuring a lot of cash up or going a lot of sales in the next couple of months. And that's how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And we do have the 4 different valuation models. We do have Graham's revised valuation model, we do have the discounted cash flow, the dividend discount, and the multiples valuation. And I have used the EPS that the board gave as guidance instead of the actual EPS, just to have it as conservative as possible. And with the current yield of the AAA corporate bonds at 4.24, we are actually seeing the intrinsic value is just above what the current value is right now. And for the discounted cash flow, I had to do a little bit of tweaking to actually get it to work, since they did produce negative cash flow this quarter. But as we can see here, I've applied a conservative growth rate of only 5%. And for the dividend discount, I have also applied a pretty conservative growth rate of 5%. And for the multiples, I used the EPS of 5 as forward guidance once again, rather than their actually earnings per share. And that gives us a average intrinsic value of 116. With a margin of safety for 10% only. I think that's quite fair, since it is a dividend aristocrat and a dividend kings, as mentioned earlier, and that gives the acceptable buy price of $104. So I would say that it is an acceptable buy right now if you are interested in Stanley Black Decker. And as a disclaimer, I did purchase shares right after the drop. Let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. And thank you so much for watching this video, guys, and please don't forget to like and subscribe to the channel.